Welcome, everyone. I'm economist Robert Murphy, and this is business consultant Carlos Lara. We're broadcasting from Nashville, Tennessee. It's late September 2016. And what we're going to be talking about is the coming financial storms and strategies you can use to protect yourself from them. Now, just to give you some introductory background here, Carlos and I have been touring the country, giving public talks. We've written a book. We have a podcast. We have a website set up, laramurphy.com, devoted to disseminating this information. But we thought it was important for us to condense it down into a brief message to give to you in this format. So I should say that a lot of what we're going to talk about tonight, just because of the constraints of time, we have to condense it down into very bite-sized chunks. But if any of this whets your appetite and you want to learn more, we're going to provide you with plenty of material for further information. Just to give you a little bit more of a background on how we came together and why we're now here giving you this message, I should explain that I originally moved to Nashville back in 2006. I was working in the financial sector, but I had also been in the academic sector. I had been touring, writing books on Austrian economics, and it just so happened that Carlos was at that time going through and trying to learn more about the banking system, and he was using a study guide I had written for Murray Rothbard's work, and he saw in the back that I lived in Nashville, and so that's how we came to meet each other. And at that time, Carlos introduced me to the work of Nelson Nash, particularly this book, Becoming Your Own Banker, and we're going to talk more about that later on. And Carlos was very much intrigued by this and asked me to investigate it. I did. The more I studied Mr. Nash's work, the more I realized that the infinite banking concept, IBC, was something that people really needed to check out and study. And then actually what happened further was Carlos and I ended up writing our own book, How Privatized Banking Really Works. And what we were just trying to do in this book was to sort of marry Austrian economics and Nelson Nash's infinite banking concept, IBC. And the insight that we tried to put forth in this book was to say that what the Austrians were doing, they had correctly diagnosed the problem. They understood what was wrong with our financial system and how banks operated in the modern era. But the strategies they were offering to people, although they would work, they involved mass changing of public opinion and changing government and Federal Reserve policies, which that ultimately would be the true solution. But we realized a lot of people would say that's not going to happen anytime soon, and it would be lead to despair and despondency. Whereas what Nelson Nash was offering was something that individual households and business owners could do immediately without waiting to change public opinion. And so just one household or business owner at a time could effectively secede from this system. So that's what we were trying to get forth in our book, and we just came together, and that's now to give you the background as to how Carlos and I have been going around and what our joint strategy is and our mission to try to educate the American public. So I should mention, as one final remark before I turn the microphone over to Carlos here, that the message we're going to give is going to be bleak. And we understand there are lots of people right now warning people the end is near, doom and gloom, and some people just dismiss this all as people being perma-bears and what have you. We're aware of that, and all I can say is we're going to try to be very sober in the analysis. You're going to see we're going to have a lot of facts and statistics. This is not merely an emotional plea. This is serious information. What can we do when we think things really are this dire, except to warn people about the coming financial storms that we see on the horizon?
Thank you, Bob. Well, as Bob mentioned, I'm a consultant and a workout specialist in a firm that I established in 1976. And I got into Austrian economics after getting financially clobbered during the period of the 1986 Tax Reform Act. Now that was soon followed in October of 1987 with Black Monday, the worst stock market crash in history up until that time. And then that crash was followed by the crashing of the residential and the commercial real estate market to a level that had never been seen before since the Great Depression of the 1930s. It was a bad time. Though my family and I suffered immensely during that period, fortunately, I did not have to file for bankruptcy, but the record shows that millions of businesses and individuals did. Now, what I most want to tell you is that none of my personal high-priced financial advisors saw any of this coming. I was 40 years old at the time. This was actually my first realization that these economic crashes don't just mysteriously happen. They're created. And this is what led me to further research and further study. And I eventually came to realize that it was these Austrians that really understood the business cycle. And that's really what brings us here together tonight, because we think that the Federal Reserve and other central banks around the world they've done it again. They've blown up a giant bubble that can't possibly be sustained much longer. Now, what we don't want to do is string you along. I'm going to tell you right now what we believe is the strategy that you should implement. And then we're going to spend the rest of this time talking to you about the exact nature of the problem and why our recommendations will help you weather the coming storm that is coming our way. So here now is the strategy that we are recommending. As you can see, it's a 3-step plan, and I want to walk through each one of those steps. The first step that you should do is to begin as soon as possible to build up a stockpile of currency, cash, and have it in your possession. Now here we're talking about a minimum supply of 30 days of living expenses or an operational expenses. You should have this in your possession. You should store it in some sort of a fireproof container or a safe. Step 2 is that you should begin purchasing gold or silver, and you should physically own it. Now here we're recommending that you buy it not as an investment, but rather as emergency money. And you should buy it in amounts equivalent to a minimum of 6 months and up to 18 months. And then step 3 is that you need to move forward and set up an alternate warehouse for the remainder of your dollars. Now here we are specifically talking about Nelson Nash's infinite banking concept, or for short IBC, and that includes a dividend-paying whole life insurance contract. As Bob has already alluded, that we brought the marrying of Austrian economics and the infinite banking concept together for a purpose, which we will get into much deeper in just a little bit. But Nelson Nash's IBC involves the use of the oldest financial contract in the insurance industry next to term insurance. That financial contract is the dividend-paying whole life insurance contract. It should be specially designed according to Nelson Nash's specifications. And it should be purchased from a mutual or a mutual holding company where the policyholders are also the owners of the company. Now, at this particular time, the primary reason for taking these important steps is because of the inherent systemic risk problems that we find with commercial banks. And that is due to fractional reserve banking, in combination with the recently enacted Dodd-Frank Act. Together, these two had made keeping money in commercial banks very risky for all of us. And I will explain that in detail in just a minute. But among some of the more positive reasons why this alternative cash flow system that we're recommending is superior to the one that we're all currently using right now with banks is because of the control and ready access that we have to our money when we need it, especially when it comes to loans and lines of credit. These can be readily accessed with terms and repayment flexibility that are not found in the commercial banking system, or really anywhere else for that matter. We will explain that in detail as well. But not only do we find guarantees that are built into the IBC method, we also have tax benefits and uninterrupted compounding on the growth of our money. And that means zero market volatility. That growth on our money includes interest and even dividends that are paid to us as participants and legal owners of the mutual insurance company itself. Now, in a few minutes, I'm going to direct you and show you exactly how you can obtain one of these specially designed insurance contracts from an extensive list of authorized IBC practitioners. These licensed financial professionals are also graduates of the training program that Bob and I helped develop. We can vouch for these approximately 200 financial professionals, no one else. But before I direct you there, Bob needs to go through for a few minutes and explain to us the nature of our current economic problem and how it is being precipitated to the degree that we see these crashes coming much, much sooner than even we expected. Bob?
Thanks, Carlos. So I just want to brag on Carlos a little bit, folks, because he's being very modest here, but I do want to stress he's going to get into what he found with the Dodd-Frank Act and how that relates to commercial banks and why your money isn't safe there. And this was stuff that he dug up well before this type of stories were being broken on Zero Hedge and places like that. So this is how I knew that, okay, yes, I've teamed up with the right guy here, that his background in bankruptcy proceedings and so forth allowed him to sort of pierce the veil. Because if you've ever looked at any of this legislation, it's written in lawyer language. So average people don't even know what it's talking about. Perhaps that's why the politicians don't even read these bills before they vote on them. In any event, this stuff really is things that Carlos was onto well before even these sort of alternative sites picked up on it. And so I really do encourage you to pay attention to the warnings he's going to give. But as Carlos mentioned, we have to give you the big picture. Why is it that we think that right now we are on the cusp of another major crash in the financial sector? And again, Carlos came to this through personal experience that he got hit in the 87 crash, and then went on a personal odyssey to discover what happened. That led him to Austrian economics. I was coming from the academic world, as I mentioned, and then actually I was looking in 2007 with fresh eyes, as it were, and realized, oh wow, they really have blown up a giant bubble in the housing sector that's going to come down. So there were plenty of Austrians warning about the housing crash well ahead of time. You may be familiar with Ron Paul's warnings, for example, Peter Schiff, people like that. So what I'm going to tell you right now is just spend a few moments and let you understand how is it that people who have studied the Austrian School of Economics, why do they think they have certain insights into the nature of the business cycle? Now, it should be clear, Austrian economics, it doesn't give you a crystal ball, and some of the greatest proponents of this viewpoint, like Ludwig von Mises and Murray Rothbard, Friedrich Hayek, they would be very modest and say, look, we're not giving you a way to predict the future. That's part of the essence of Austrian economics, is to eschew mathematical formulations and to say humans are unpredictable. You can't really write down an equation to say what people are going to do tomorrow. So I want to be clear, A lot of what we're going to be telling you tonight is going to be infused with our own personal judgments, but the framework that we're using to make these judgments is Austrian economics. So let me just very briefly explain that framework. Put simply, the theory of the business cycle is developed by Ludwig von Mises and refined by his follower Friedrich Hayek, is to say that the normal boom-bust cycle that you see in market economies, that's not normal. That's not just, that's capitalism for you. You have to be willing to take these downturns if you want to have the upswing. No, what Mises said is that itself is the product of government intervention. So specifically what happens is the commercial banks, and in modern times under the guidance and the cheerleading of and the protection afforded by the central bank, the commercial banks flood the market with cheap credit that's not really connected to genuine savings. And so what that means is the interest rate that gets charged on loans is pushed artificially low. And so that gives the green light, as it were, to businesses to invest in long-term projects when really there's not enough genuine savings available physically to carry these projects to completion. So one way I like to motivate this is to say that in the Austrian view, market prices perform work. They give us information, right? That market prices really have a job to do. And so just like if the price of crude oil is $80 a barrel, that means one thing. If it's $30 a barrel, that means something else about underlying scarcity, availability, production, opportunities, and so forth, consumer preferences. Those market prices mean something if we're talking about something like the price of a barrel of oil. So by the same token, the short-term interest rate, that really means something. And so if the Federal Reserve comes in and the market rate of interest ought to be 4%, and instead the Fed is stimulating or trying to encourage spending and so forth by pushing down the interest rate to 0.5%, you're not doing the economy any favors. That's the wrong price. It's giving people the wrong information. So when it comes to interest rates and credit, what's really perverse is it's not immediately obvious that it's the wrong price. What ends up happening, and this is the theory that Mises and Hayek developed, is to say if there's an artificially low interest rate, that can set up an unsustainable boom. So for a few years, as long as this boom continues, it seems like it's great. There's apparent prosperity. Workers' wages are rising, unemployment's low, businessmen are earning excessive profits, they have high dividends, they're giving bonuses to their key employees and so on. Everything seems great. Workers can quit one job, go somewhere else, get a better paying job. Everything is humming, everybody's happy, and then for some reason it all comes crashing down. And so again, in the Austrian story, what's happening there is that artificial boom period is the problem. So one way to put it is to say Keynesian economists tend to focus on the downturn, the crash, and they say, why is it that all of a sudden people aren't spending enough? And then they scratch their heads and try to figure out ways to get consumers and businesses to spend more in consumption or to invest more. And gee, if they're not willing to do it, I guess the government needs to come in and just spend money. And who cares what it's on? We just got to get spending up. Whereas the Austrians say, wait a minute, why is it that all of a sudden aggregate demand collapsed? Is there something earlier that we need to look at? And so in the Austrian view, the only way to ultimately get rid of these horrible downturns is to avoid the preceding boom period. Whereas in the Keynesian view, they typically like the boom period and then just think, oh, if only we could keep that spending going on indefinitely. So that's the basic framework. Now, to give you some motivation as to why do we think right now we're in the midst of a very unsustainable boom, you're going to see a chart in front of you. So what this chart shows, I got this from the St. Louis Federal Reserve. You can go reproduce this if you'd like. This is going from January of 2009 up through the present time, September of 2016, and you'll see the blue line is the S&P 500 index, and the red line is showing what technically it's called the St. Louis Adjusted Monetary Base, but if you just want to loosely think about it, that's sort of like the total amount of money that the Federal Reserve has been pumping into the economy. So this is like the high-powered money that the Fed directly controls. Okay, and so as you can see there's a few things I want you to take away from this chart. First of all, notice how closely those lines track each other. And I should just mention, in case you've never seen something like that, that's not normal. All right, I zoomed in on 2009 to the present just to get the fit to show you how closely they match. But if we took a longer-term view, you would see that they don't typically line up like this. The stock market does its thing, and the Fed usually wasn't doing too much. But since the rounds of so-called quantitative easing, you can see how the stock market has tracked what the Federal Reserve has been doing. So I'm trying to give additional evidence here to buttress our story, our narrative, saying this alleged recovery that's occurred during the Obama administration, we think is built on quicksand. Right? That the fact that the stock market has boomed so much since the initial plunge after the financial crisis, we don't think is evidence of the great policies that the Obama administration has put into place and the wise stewardship of the Federal Reserve. On the contrary, we think that Ben Bernanke has blown up a much bigger asset bubble than Greenspan did during the housing bubble years. Right, so that's one thing I want you to take from this chart. Another thing, though, I want you to focus on, look at the two black braces that I've indicated here in those two spots, and you'll see that those are the two spots since early 2009 where the blue line and the red line have the biggest gaps. And so what that means, if you see the blue line's higher than the red line, so that's saying those are periods where for some reason the stock market was moving up even though it seemed like the Fed wasn't accommodating, that the Fed hadn't been pumping in a bunch of money and yet the stock market was going up. So you saw the way that was resolved in around January of 2011 when finally that red line shot up and caught up, as it were, to where the blue line had moved up. And so my interpretation there is to say investors on Wall Street and around the world knew that the Fed was going to come in and pump in more money and have another round of QE. So that would have been QE2. Right? And so in other words, stocks started rising in anticipation that the Fed was going to bail us out, and they weren't just going to sit back and let the market crash. And so, yeah, and they did. Right on cue, the Fed all of a sudden pumps in a bunch of money with QE2 there. Again, looking out at the end of this chart, and you can see as of right now, when we're giving you this message, the stock market, if you buy into this general correlation that we've seen since the beginning of the extraordinary accommodation, the stock market right now, according to this metric, is overvalued. And so the question is the Fed going to accommodate? Are they going to come in and say, okay, yeah, actually the markets are starving for more liquidity, we need to have QE4, or is the Fed going to stay pat and say, nope, we've really done as much as we're going to do, we got to ride this thing out? So let me be clear, at this point, the Austrian economics per se doesn't tell us what's going to happen over the next 12 months. What Austrian economics tells us is that if you have an unsustainable boom, it's going to come crashing down, and the things that contribute to an unsustainable boom, but it doesn't tell you timing. And in particular, people using an Austrian framework, myself included, we've been worried for years at this point that Bernanke was blowing up a giant asset bubble. But as long as they kept pumping in more and more money, the bubble kept going up higher and higher. So the question is now one of a judgment call to say, is the Fed going to come in with another burst of liquidity and pump up the bubble even more and get us a few more years, or are they just going to say, you know what, we got to stop? So my personal judgment is there's going to be a crash before the Fed comes in with another huge burst of liquidity. And the reason for that is, number one, if you just look back at the history of new Federal Reserve chairs, there is this pattern where, I checked it going back at least to Volcker, when a Fed chair comes in, there is usually a large crash within about 2 years, and often much sooner. If you look at Greenspan, he came in and then it wasn't even a full year before you had the biggest crash, as Carlos mentioned, in history to that point. So there is this pattern. So we can explain that with both Austrian economics and then there's our knowledge of how politics works. If you think about it, that it would make sense a new Fed chair comes in, dealing with the previous bubble the last person blew up, and then said, here you go, good luck with that. There's a big crash. Then what do the Fed chairs do? Well, according to the Keynesian textbooks, they cut interest rates, flood the market with liquidity, and then, there's a recovery. They blow up another giant asset bubble. They start reading the writing on the wall, and they all of a sudden decide to retire and go write their memoirs and hand that mess off to the next person. So I think what happened is Bernanke came in, there was a huge crash, the housing bubble collapsed, and it wasn't totally his fault, that Greenspan had a lot to do with that. Then he blew up another giant bubble, realized that, and then they handed it over to Yellen, and now it's her job to oversee this big crash in as best way she can. So I don't think the Fed is going to expand until something really awful happens. And just look at a little bit of the clues here. The so-called taper, that was when QE3 wound down. right? That they had originally been buying assets at $85 billion a month and then started reducing it. That was supposed to happen in September of 2013 under Bernanke. They didn't do it. They pushed it back to December of 2013. That was when Bernanke officially stepped down. Yellen gets, the Senate confirms her in January of 2014. She's sworn in, and that's when the taper fully goes into motion. Okay, so in terms of a regime change, if you will, it really does look like Yellen comes in to oversee this switch from expansion to let's hold it pat. And in particular, the chart indicates it, but also just various other measures you can look at. A lot of people, I think even hard money types, Austrian libertarians, they have this idea, oh yeah, Bernanke and Yellen have been inflating like crazy. No, Bernanke inflated like crazy, but if you look at certain metrics, Yellen actually has been overseeing just holding steady. In particular, since the fall of 2014, the Fed has just been rolling over its portfolio. As certain bonds mature, they go out and buy new ones and replace them, but their overall position has been neutral from that point forward. So in that respect, my reading is that Yellen, and they raised interest rates also. So I think the Fed is actually trying to tighten, but trying not to cause a crash. And so I believe we're going to see this bubble eventually pop before any dramatic action by the Fed. Let me also just mention, again, this is sort of anecdotal, but in terms of giving us a framework, historically, the 5 biggest percentage drops in the U.S. stock market all happened in the fourth quarter. And the 3 biggest drops all happened in October. Right, so again, if we've primed you to think, yes, there's a crash coming, we just don't know when, it'll probably happen in the fourth quarter. So if it's going to be this year, it's going to be very soon. Maybe we'll get through this year, maybe we won't. We don't have a crystal ball, but I'm just priming you to think that this is partly why we want to deliver you this message right now, because we think it's really urgent. One more thought on this issue of timing. Let's suppose you hear this message, you're intrigued, you start doing research, and boom, the stock market crashes and it's bad. Don't think, oh, I missed it, too bad I didn't hear about this 6 months ago. Because in the dot-com crash and the housing bubble crash, yes, there was a big drop, but then the market kept sliding further and further. So in particular, the dot-com crash, the market fell 48% total over 2.5 years. Okay, so when the market finally bottomed out, that was a 2.5 year span. In the '08 crash, the market dropped 50% total, but that happened over a year and a half. Okay, so again, even if you hear this, we intrigue you, and you don't take action, and then there's a big drop, don't worry. You still have time to do something that, assuming history repeats itself, that the market would continue coming down. Let me also just mention that in terms of sequencing of events, we're warning about the threat to the dollar and so forth, but the immediate threat we think is to the U.S. equity markets. It is possible that there's a bad crash also in Europe, and that perversely could make the dollar strengthen and treasury yields fall, right, as people panic and rush into the apparent security of the U.S. dollar. So that is consistent with our worldview. We're not saying the dollar is going to crash 6 months from now. We just think that's more of a long-term threat. So in terms of the sequence of these storms, the thing that we think is on the immediate horizon is a drop in U.S. stock markets and real estate markets. But the dollar itself, again, that may strengthen first just because the situation's bad in Europe as well. So just so you understand. Now, one last thing I'll show you. There's going to be a new slide flashing up of what's called the Exeter pyramid. Let me just explain what this is, and then I'll turn it back over to Carlos. This guy, John Exeter, he wasn't Fed chair, but he was high up in the Federal Reserve hierarchy. And in the 70s, he did a lot of research on financial crises, panics, both in the U.S. and around the world, and just wanted to draw some conclusions, some patterns. And this pyramid is showing the rush to liquidity, all right? And that what happens is, you can see from this, the top where it's in red, that's the stuff you don't want to be in if a panic ensues. That stuff drops in value very quickly, and the stuff towards the bottom of the pyramid, is where you want to be. That's the stuff that's going to gain relative, right? So it may be the absolute levels of prices move based on the strength of the currency, but these are showing relative movements in valuation of these types of financial assets. So as you can see, when there's a panic, people rush to things that are liquid. So this idea of liquidity, you could have a house that you say, oh, my house is worth $200,000. You don't mean that tomorrow you could turn your house into $200,000 in the bank. You mean if I marketed it properly, had 6 months, right? So a house is not very liquid, whereas a share of a major corporate stock, that's pretty liquid. You could call your broker, turn that into cash pretty quickly. So that's the way to think about stuff that you can turn into cash very quickly is the sort of thing that people value when there's a panic and there's uncertainty. They rush to stuff that they know they're not going to have trouble finding a buyer for. And then ultimately, as you see, gold, we could also put silver, the precious metals are at the base of this pyramid, because if a really bad situation happens where even the currency itself is in danger, people rush to the market's money, the historical money, the stuff that people voluntarily use as money, namely gold and silver. Okay, I'll turn that over to you, Carlos.
Well, hopefully you're getting a sense of the urgency and the importance of implementing the strategy that we're recommending from some of the things that Bob has been talking about. I guess what we're stressing is that the global markets are poised to crash, and really just even a modest shock, could send the whole house tumbling down across international borders. I mean, that is how fragile and explosive everything has gotten. Also, I want you to think for a moment and realize that historically, when there's a crash, people panic, and the very first thing they do is they run to the bank to get their cash out. And this is when people realize that their cash is not there. And that's due to fractional reserve banking. That's what I mentioned earlier. And this, of course, causes the bank to fail, but not just one falls. I mean, a whole string of them fall, almost like falling dominoes. And this is what I'm referring to as the core systemic risk problem of banks, that they fall, and it's a bunch of them that fall. Now, this is one of the primary reasons for the creation of the Dodd-Frank Act, and that this was enacted into law in 2010. If you read this document the way I have, and if you understand bankruptcy law, what you discover is that in this next financial crisis, the too big to fail financial institutions will not be bailed out with taxpayer money. I mean, that's the main thing that you recognize and see very quickly. Instead, what these failed institutions, what will happen to them is that they'll close them down, they'll be sequestered, and an attempt by the authorities will be made to resuscitate the failed institution using the institution's own pool of capital, which is made up of stockholder and creditor monies. And this creditor monies is specifically what has made the Dodd-Frank Act so dangerous for us. Because just being an ordinary depositor in a commercial bank places our businesses and us in harm's way. And that's on account of another banking law that's been on the books really since the inception of this country. It's never been much of a problem for us until now. You see, when you deposit money into a commercial bank, we all do this all the time when we drive through the drive-through. We put our paychecks in those plastic tubes, or we put the revenue from our businesses in those plastic tubes. We send it down the chute. When the teller picks up that plastic tube, at that very moment, the title to your money changes hands. The bank now owns the money. They can do anything they want to with that money, even gamble it away if they wish. Now, they do owe you the money, but legally, you are now a creditor of the bank. So, do you see the connection I'm talking about? If your bank fails, and you as a creditor of the bank or as a depositor, you could have your money trapped in a rehabilitation effort of the Dodd-Frank Act. Now, this is known as a bail-in, as opposed to a bailout where they use taxpayer money. Now, We haven't seen a bail-in in this country yet, but we know how they work because we saw how they worked in Europe. Do we all remember what happened in Cyprus in 2013? That could be considered as a test sample of what a bail-in, how it works. The people in Cyprus woke up one weekend morning to do their normal weekend shopping and dining out, and they go to their ATM machines and they're locked out. They can't get to their cash. So in a panic, they go to the branch bank to see what the problem is, and what they find there is a big crowd of people, a sign on the door of the bank, and this is all the branches of the two largest banks in Cyprus, saying that the bank is closed until an indefinite period of time. And the result was that they stayed closed for 12 days. So you need to stop and think, can you exist without being able to access the money in your checking account for 12 days? Well, the folks in Cyprus didn't do so well. A lot of businesses actually collapsed during that period of time. When the banks finally reopened, a few of the depositors, the smaller depositors, got their money. Most of the bank depositors got a note or an IOU that they might be paid sometime in the future, or worse than that, they got stock or equity in a defunct bank, which, by the way, ultimately closed down altogether. So this is what we're seeing a bail-in is like. It comes with a crisis or a crash, and we're asking, what's going to trigger the next crisis? Well, Bob's already alluded to the fact we can't know exactly when. Is giving you some idea of how they happen, but we can't really know. I'm going to step out here and say probably start with a derivatives market, because that's what triggered it the last time when they got involved with the money market funds. And the derivatives markets, if you check it out now, they're flying high again. The Bank of International Settlements, which is the central bank for all central banks, puts out numbers saying that the worldwide, the estimated value of derivative contracts worldwide right now is sitting at $700 trillion. And at the same time, it's saying that the GDP of the whole world is 75 trillion. Now, I realize these are vague concepts, but just look at the disparity between those two numbers. 700 trillion, 75 trillion. I mean, really, there's not enough money in the world to cover those risky bets. If you're thinking to yourself, well, I don't know that I need to take this thing all that seriously. I've got the FDIC that's covering my checking accounts. I mean, if I reach 250,000, I can just go over to another bank, open another bank account, and have coverage for another 250,000. Let me remind you what happened in the 2008 financial crisis. We had 1,200 banks go underwater. 1,200. Now, the whole Federal Reserve System has approximately 3,500 banks, and 1,200 of them went underwater. So the FDIC was very busy going around the country trying to shore up all these bank accounts. But folks, they ran out of money. I mean, at some point, it went $20 billion in the hole. They had to go to the Treasury Department to get a loan just to finish out covering all the bank deposits. We have to remember the Dodd-Frank Act is now saying no more taxpayer money is to be used. The bank, the Office of the Controller to the Currency, the OCC, has got numbers posted out there that the FDIC has approximately $71 billion in the coffers of the FDIC right now, which sounds like pretty impressive numbers to deal with all the total of U.S. bank deposits, except that the total of U.S. bank deposits is $10.1 trillion. So again, notice the disparity between those two numbers. For those of you that are mathematicians out there, do the calculation. The FDIC can cover maybe 0.25% of the total of U.S. deposits. In light of everything we've said, hopefully you're beginning to see why you need gold and why you need cash in your possession. It might be good to show our strategy again while you think about this. You need the cash to draw on if there's a temporary panic and everything shuts down. There you're going to have at least 30 days of living and operating expenses to work with. The gold is there if and when the dollar crashes. Unfortunately, matters have gotten to such a point that this could actually happen. And obviously we must prepare for it. The gold becomes your emergency money. But you also want to prepare for the now and the long term. And here we're talking about just being able to function in the U.S. economy using fiat money, which is what we use, fiat money. But we want to be earning an income on that money without being at risk in the market. And this is exactly where IBC comes in. Now keep in mind that this is not an investment. Folks, this is life insurance. But we're using the dividend-paying whole life contract as a way to practice IBC. And in doing so, we're able to continue to utilize all of the cash flow features that we find in commercial banking, especially the use of loans and lines of credit in the very same way, but without having to go through a credit check. That's one of the big keys of this, no credit checks in order to access this money. And with immensely flexible repayment terms, another big point. In fact, the repayment terms are so flexible that you, the policy owner, not the insurance company, are the sole determinant of when these loans get repaid. Now, if you stop and think about that, that makes for an excellent cash flow system that truly allows you to plan ahead. Now, finally, let me show you where you need to go to find an authorized IBC practitioner so that you can access one of these specially designed insurance contracts. So what we're going to show you now is a page that is found on the website, the Nelson Nash Institute website. That website address is infinitebanking.org, and this page is infinitebanking.org/finder. Now there's also a quick link to get you to this very same page, which is talkibc.com. talkibc.com. That should take you to the page that you're looking at. And what you see here is a map of the United States. A little further down the page, which we can't show you on this slide, you're going to see that Alaska is over to the left, and then Puerto Rico is over to the right, and then underneath it you have Canada, because we have, as I said, approximately 200 authorized IBC practitioners that are all graduates of the training program that Bob and I created, and they're in all these areas. So what you do is you take your cursor and just move it along the state where you're located. Say, for example, if you move your cursor along the state of Texas and you click the state of Texas, you would see open up a list of several authorized IBC practitioners that are resident in the state of Texas. Underneath that, you're going to see an additional list of authorized IBC practitioners, and these are financial professionals that are authorized to transact business in the state of Texas. So as you move through each one of the states, you go into Canada, if you happen to be in Canada or Puerto Rico or Alaska, you're going to be able to find one of these practitioners there that can answer your questions, and you should begin some sort of a dialogue with the individual and move towards setting up your alternate cash flow system. If you're not ready to meet and talk to one of these individuals, well, certainly you can spend a lot of time, not a lot of time, but enough time on our website, laura-murphy.com. There's all kinds of information there that can teach you all about IBC. Bob and I do podcasts that spell out exactly how IBC works, that I would suggest that you listen to, and I believe it's episode, is it 18 or 17 and 18, I think, in particular, that can teach you a lot about IBC and getting ready to talk to an authorized IBC practitioner. And then, of course, if you have still questions, you're not ready to do it yet, you want to ask us, Bob and I, just email us. We'll be glad to answer all of your questions. So, Bob, you want to add to that?
Well, sure. So thanks, Carlos. In the remaining segment here, let me just reiterate exactly what IBC is and try to answer two common objections we hear. So again, our strategy, I hope you can see the connection between the three steps we've outlined and how that protects you from the storms that we see on the horizon. So I think a lot of you can understand, why would I have physical currency in my possession? Well, if the banks go down for a while, that makes sense. The people in Cyprus, if they had a month's worth of currency actually in their physical possession, they would have been okay with the bank being down that weekend and for those 12 days. So that's pretty obvious. Gold and silver, I'm sure most of the people watching this, you're already well aware of the advantages of having the true market money in case something happens to the currency. And again, why do you want to have it in your physical possession? Because who knows what could happen. The kind of panic we're talking about, you might have shares of a gold ETF in your 401k, and then all of a sudden the president might declare there's some kind of emergency and a run on the dollar, and speculators and those things can get canceled or temporarily suspended. Who knows? So better to have it physically in your possession, and of course you want to take steps to actually secure them. But as far as this last step in terms of having a cash flow management system, that's where IBC comes in. So again, the critical reading here is this is a guy who invented the concept, Nelson Nash, the infinite banking concept, IBC. So let me just spend a few moments explaining what it is. But again, as Carlos says, you got to read the book. Go to our website, lauramurphy.com, listen to our podcast, and in particular, as he says, episodes 17 and 18, we started from scratch and said, assume you know nothing. What is this IBC? How do I learn about it? What do I do next? That's what we cover in episodes 17 and 18 of our podcast. But for right now, here's what it is. You take out a dividend-paying whole life insurance policy. Now, it's going to be calibrated a certain way, but at this level, let's not worry about that. And you're going to build up cash value inside of it. So this is a normal feature of a whole life policy. It's nothing unusual. What happens is a whole life policy means you have it for the whole life, hence the name. And so as long as you keep making your premium payments, they know eventually they're going to have to pay you, right? A term policy is saying if you're a 35-year-old and you take out a 20-year term policy, that policy coverage is in force for 20 years. But once you turn 56, you got to go back and get a new policy if you wish, or just drop your coverage. A whole life policy, once you sign the contract, that thing is in force. As long as you keep up your end, they have to keep the policy in force. They know they're going to pay you at some point. So they're taking your premium payments and putting them to work buying assets, so that they can, on their books, the life insurance company can have assets growing, tracking you in the book of business they've issued to make sure that when these people start dying, they've got enough to be able to pay the death benefits. Okay, so at any given point, if you want to surrender the policy, they give you a spot payment. It's less than the death benefit, right? Because the death benefit isn't something they would owe you until the future. But if you want to just surrender the policy, they give you the cash surrender value. All right, and so because you're removing the liability from their books, now they don't got to worry about when this guy dies, we owe him the death benefit, or his estate the death benefit. So that cash surrender value now is something that's growing inside the policy. And another feature of these policies that's quite standard is you can borrow against it. So that cash surrender value is the collateral on which the life insurance company gives you what's called a policy loan. So Nelson Nash's idea, what he talks about here, he had this epiphany, and he'll explain, he doesn't take credit for it, he was in prayer when it occurred to him, is he says, this is the way you become your own banker. You build up cash value in one of these dividend-paying whole life policies, a very boring, conservative thing, nothing fancy here. It's there, you know it's going to be there. These life insurance investment departments are very boring and conservative. They're not trying to post good returns every quarter. They're just trying to make people be very secure and know their money's safe. And when your daughter's getting married, you got to buy a car, send your kid to college, these major life events that a lot of people now would turn to outside lenders. Nelson Nash is saying you build up sufficient cash value in one of these policies and then you just borrow against the policy. So that's the sense in which you're becoming your own banker. And as Carlos mentions, there's lots of reasons why that's very advantageous to do it this way. In particular, when you go to take out a policy loan, the bank doesn't ask you, oh, what's your income? What are you going to use this money for? What's your social? We're going to run a credit check on you. They're not even going to say, when are you going to pay it back? They don't ask any of those questions. The life insurance company sends you the check. Now, that might sound too good to be true, and in a minute I'm going to explain why it isn't too good to be true. It makes sense once you get the mechanics of what's going on, but I just want to get you to see this is why Nelson Nash and his legions of fans believe that, oh wow, this guy's a genius, he's really found something here. It's this normal, conservative, boring financial product that's been around forever just sitting here, and this is the way that you can secede from this Wall Street Federal Reserve nexus that we see is poised to collapse. So let me just deal with two quick objections just to teach you more about how IBC works. But again, we know we're just throwing things at you and you're going to have to do more research to really learn about this. So one objection we get is to say, okay, you guys have scared the heck out of me. Thank you, by the way. Now I don't know what to do. You're warning me the banks are going to go down. Well, what good is it if I have cash value built up in a life insurance policy? How am I going to get that money? Right? They're not going to mail me a bunch of $10 bills. So don't we need to use the convert? A very safe, fair question. So there's varying degrees of things. We're not necessarily saying it's going to be a Mad Max world next Thursday. What we're saying, though, and this is what happened in Cyprus, this is what happened in 2008, even during the Great Depression, it's not that every single bank failed. It's that there were bank runs on the banks that had gotten into very risky lending opportunity or lending projects, and then the public caught wind, and so it was banks that were ones that had been engaged in dubious practices that the ones that tended to get hit with the bank runs. Okay, so what we're saying is, for all you know, the bank you've been using might get hit, and then if you had a bunch of your money in that particular bank, you would lose access to it. So if you have money in a life insurance policy, and then let's say there is a crisis and a bunch of the banks go down, still, if you call them up and say, okay, I'd like a $5,000 policy loan, they can send you a check, and then at that point, you can go find a bank that is still open, and then you can deposit your check and get access to the money that way. All right, so that's one thing to realize. Also, the life insurance company, it's not that they keep all of their funds in commercial checking accounts because they wouldn't be earning any interest. Obviously, their portfolio, the bulk of their assets are in fixed income primarily, but the point is they're not checking accounts. Okay, so that's the way to see that the type of storm we're worried about that could involve a bunch of banks being shut down because they engaged in dubious operations. If you had a bunch of your wealth stored in the form of cash surrender value in a dividend-paying whole life policy, you would still be able to get access to that. Okay, so that's one objection. Now, one that's more interesting is I read an economist who had looked into this IBC concept, and he said, oh, okay, yeah, it's not crazy. I get what they're talking about. They're basically saying you build up an asset over here, build some equity in it, in this case, a dividend-paying whole life policy, then you borrow against it using that as the collateral. You get somebody, institution, to give you loans with that thing as the collateral, in this case, the life insurance company itself, and then you go and spend your money that way and then pay that thing off when your money comes in. And so that's the way you're getting access to cash flows and managing them, is you build up this asset over here on the side that has a lot of equity, and then you use that as collateral. So, okay, yeah, that's not crazy. There's nothing wrong with that, but so this critic said, why would you need to use a life insurance policy? I'm skeptical. I think they're just trying to get people to buy life insurance because I could do that with my house, right? If I have a house that's got a lot of equity in it, and then why can't I become my own banker with my house? Again, this is the critic talking, and I'm going to explain what's wrong with this train of thought. And so he said, I could just go to the commercial bank, say, hey, I've got $100,000 of equity in my house. I want to take out a $50,000 home equity loan. That's very over collateralized. They should grant it to me. Now I got $50,000. You know, if I want my daughter's getting married, I got to send a kid to college. Why don't I do that? What's the difference? I can become my own banker with any kind of asset. There's nothing special. So I smell a rat. Right? We've encountered that kind of objection. Let me explain what's wrong with that, and that no, the stuff Nelson's showing you can do in this book, you cannot do it with another asset. And it's not anything mysterious. It's when you think through the logic of what's happening. So with a dividend-paying whole life policy, the life insurance company itself is guaranteeing the collateral. Right? That's a contract you have with them saying, if I surrender this policy X years into it, this is how much the life insurance company is guaranteeing they're going to give me back, you know, based on the years that I've been paying premiums into it, right? So the life insurance company itself is guaranteeing the collateral. So when they make loans against that, they know you're good for it. Even if you don't pay them a dime, on their books, that policy loan's rolling over earning interest at the specified contractual policy loan interest rate. So even if you don't pay a dime, they're keeping track of it. When you surrender the policy, if that's what you decide to do, that's when they settle up. They say, okay, right now, contractually, we owe you $85,000 in surrender value, but right now the value of your outstanding policy loan is $25,000, and so we only owe you $60,000 net, right? So they pay the loan off that you still owe them before that check goes out the door. Or if you were to die, right? Let's say there was an outstanding policy loan on the books, you get hit by a bus, you're dead. Before they send that death benefit check out the door, that's when they settle up. Okay, so the life insurance company, when they make policy loans to their customers, the owners of the policy, if it's a mutual company, they know they're going to get paid back. So in that respect, from a life insurance company's point of view, policy loans are the safest possible investment they can make. They're even safer than treasuries, because in theory, Uncle Sam could default. If you're holding treasuries, he might just, Uncle Sam might say, can't pay him. But policy loans, no matter what the client does, the borrower, the insurance company knows they're getting paid back because it's the life insurance policy itself, its cash surrender value, that's the underlying collateral. In contrast, if you're a commercial bank and you make a home equity loan, you're not guaranteeing the collateral. The collateral is the house. So the real estate market could crash. That actually happened, right? Things that were considered to be well over collateralized loans when the real estate market was booming, all of a sudden the market crashes in certain, Phoenix and so forth. Things that may have been very over collateralized home equity loans at that point no longer are, right? So that's just one particular example. Also, it's a pain, right? Even if there is bail collateral in there, if the client doesn't pay back the loan on a home equity loan, they start falling into default. What's the bank supposed to do? They got to call the sheriff, kick the people out, foreclose on the house, sell it, Nobody wants to do that. That's a logistical nightmare, right? The commercial bank does not want to be in the business of kicking people out of their houses, selling them to get paid off. So that's why even for a home equity loan where there's a lot of collateral, they're going to say, what are you using this loan for? What are the payback terms? What's your credit? What's your income? Because they want to see, do you have a history of paying off loans? Because they don't want it to go there. They don't want to be in a situation where they need to resort to the collateral. But again, the life insurance company, it's a matter of subtraction. If you don't pay them back because you have no income and what you spent the money on was something goofy, they don't care. They know they're going to be made whole. The only issue is when are they going to be made whole. So I'm just trying to, don't want to overload you guys with information. Just want you to see this is a very well thought out strategy, and a lot of these quick objections from the hip as to why this won't work, I've been spending years researching it, and the more I study this stuff that Nelson Nash has talked about here, the more I realize that, oh yeah, he's really onto something. There's a lot here. So in closing, let me just once again point you, the slide should be showing again, to our finder. Again, Nelson Nash, David Stearns, Carlos Lara, and I designed this training program for financial professionals, and then the graduates of this program are the ones you're going to find listed if you go to talkibc.com. The whole function of this is we're here, if you will, evangelizing to the masses. We like to talk to the public to get them to see the virtues of this, but obviously in your own individual circumstances, you're going to have all sorts of nuances. We can't deal with all these things, so that's why we're going to push you to the graduates of our program so they know how IBC works. They know how to specifically tailor one of these policies for your individual needs. They can show you different options and so forth. So we encourage you, check out our website, get Nelson's book, look at the stuff we talked about in episodes 17 and 18. But ultimately, if you're going to want to take the next step and talk to someone about how would you specifically apply IBC in your own circumstances, we're going to push you to our practitioner finder, because these are the people that work with people like you for a living, and they're the ones that are going to be able to get you going. So any closing remarks for our listeners and viewers?
Well, the main thing is that I hope you take the strategy that we're recommending seriously. I think if you'll just analyze it, you see it's common sense in view of the things that Robert's been discussing, the kinds of things I've been telling you about the current law that we're in right now with the Dodd-Frank Act. It just makes good sense. If you can move toward doing any of these things as quickly as possible, as soon as tomorrow, I would start. Build up that cash, start moving into the gold purchasing, and then make your way as quickly as possible to setting down with one of these authorized IBC practitioners. Or again, if you want to send us questions, you have more questions before you do that, we'll be glad to to answer some of your questions.